Welcome, everybody. Good afternoon. Thank you for joining us today for the third of our 4 talks in our 2024 Professional Advisor Speaker Series. I want to extend a warm welcome to all of you and a special welcome to our speakers, Michael Feispor and Zach Johnson, both at EY. You should have received their bios and outline of the talk earlier today. Michael and Zach, thank you for taking the time to prepare for and present today. And Michael, a special thank you to you for being a part of our leadership team on the Speaker Series Committee. I really appreciate the work that you do there. I hope this session today is a welcome break from a tumultuous day and perhaps days ahead. When so much is pulling us apart, I hope being a part of a community like this that brings us together is helpful to everybody. Today's program deals with gifting complex assets. I want to share a short video that outlines how we helped one family who wanted to make a significant contribution to a charity, one of the appreciated asset of real estate. Audrey, can you please show it?
The Sorority and Meltzer families decided a little more than a year ago to make its largest charitable gift in its history to Los Angeles Family Housing to fund more than 70 units of permanent low-income housing. I contacted my colleagues at the Jewish Community Foundation, and they quickly put me in touch with the General Counsel, and together the General Counsel and I discussed how a transaction might work. The Jewish Community Foundation understood the complexity from the beginning and worked with us to make sure that we minimized any heartaches in pulling the transaction off. It was a relationship that worked really well. We communicated regularly over a number of months. We simply took advantage of the skill set of the Jewish Community Foundation to fully implement this gift, which will service many, many people in housing for many years to come.
If any of your clients would like to learn more about how we can help you with these types of significant complex gifts, please be in touch with me following today's program. Lastly, before Michael and Zach begin, I just want to put a few ground rules down. I'm going to ask you to send questions to me in the chat, and I'll curate them for the end. There is a hard stop at 1 o'clock for our presenters, and if we don't get to the questions, we'll share their contact information for you at the end, and you can reach out to them directly to have your questions asked, and they'll get back to you, I'm sure. So thank you, Michael and Zach. I'll turn it over to you.
Hi, everyone. I'm Michael Feispor. I'm a tax partner at EY in our LA office. Work a lot with high net worth individuals, families, family offices, in connection with trust and estates, wealth transfer, charitable planning, and overall tax planning for high net worth individuals. So thank you everyone for attending today's presentation. I hope I don't bore you too much and that you have something to listen to and take your attention away from the elections going on right now. And a lot of the stuff we're going to talk about today is pretty complex, and we're gonna touch on concepts that are hard to navigate. So we may not have enough time to go into a lot of the details. The outline that was shared with you was over 30 pages. Thanks to Zach, who put most of it together. So I had to reduce it significantly. So we may not have enough time to get through all of it, but what we'll see through the course of this presentation is that this stuff is pretty complicated, and so like getting the right advisors and the Jewish Community Foundation involved early will really help you navigate some of the issues that come across charitable planning, especially when you're not using liquid assets. One thing that I've noticed is that the foundation over the years has become increasingly more flexible in dealing with these types of stuff. And they have the expertise to kind of guide you through it. So like getting them involved early will really help. And in a couple of instances, they've made me look really good when I brought my clients' problems to them. And so like, I thank you guys for like having such a platform to like do this. I'm going to give Zach just a second to introduce himself also, and then we can get started.
Thanks, Michael. Yeah, my name is Zach Johnson. I'm a senior tax manager at EY in the Houston office. I started my career 9 years ago, primarily with tax compliance, and over the last 4 years, I've more focused on the gift and estate planning um, aspect. So, look forward to sharing the materials that we prepared for y'all, and hope you gain a lot from it.
So before we jump into like all the materials, I just wanted to like briefly describe some definitions or concepts that are going to be relevant for the assets we're going to be talking about today. And then once we get through those definitions, we're gonna talk about like the charitable deduction limitations, because I think it's important to keep that in mind, like every time you're thinking about a structure. And then charitable trusts are pretty important when you're thinking about naming a charitable beneficiary. And when you have a client making a large gift, sometimes they want to retain more control or have something left over for them, for their kids or other beneficiaries in the future. So we'll go through like very briefly, like the two main types of charitable trusts and when they're commonly used. And then we'll end with with a few examples. Some of them are like examples of lifetime gifting. And then a lot of times clients don't actually accomplish what they want to accomplish. So then they die with all these problems. And then we're left with these assets in the estate. So we thought it'd be relevant to also talk about, if you don't deal with it while they're alive, like this is what you're going to have to deal with when they're gone. And like a lot of the concepts are similar, but there's different ways of tackling the issues depending on whether the client's alive or if you're dealing with the estate. So now we'll just jump into some of these concepts. The first one is excess business holdings. And really the purpose of this is to prevent tax exempt organizations from like competing unfairly with taxable businesses. And as a result, a private foundation and its disqualified persons, and by the way, these rules also apply to donor advised funds, may not own more than 20% of the voting stock of a business. And it rises to 35% if a third party has control. And it's pretty important to remember the exception for like passive source income. So if you have a business with like 95% or more, I think that's the percentage of its income being from passive sources, you can avoid this result. So excess business holdings, again, a charity should not have a substantial piece of a business, and the rules are there to really avoid you from gaming the system and having a charity own like 100% of a business. And again, it applies to donor advised funds and supporting organizations as well, or some supporting organizations. Another very important concept that we're going to talk about today is self-dealing. And self-dealing basically prohibits like transactions between foundations and disqualified persons. Disqualified persons are defined very broadly. So you got to look at those definitions. Like I'll just name a couple of them. Like one of them is a substantial contributor who contributes more than $5,000 in certain cases. Pretty easy to trip that up. Officers, directors, family members of disqualified persons. It's important to know that like sometimes some family members aren't considered family members for the purposes of this definition. So like anytime you're dealing with these rules, just make sure to look up the definitions and see if you can get out of it by dealing with individuals that are not covered by the definition. And so the way I like to think about self-dealing is just when you're not supposed to be dealing with your charity, it's like kind of a conflict. Like anytime you think something is off, it's probably off. You have direct self-dealing and indirect self-dealing. And by the way, we have similar rules for donor advised funds. It's not called self-dealing, but it's like excess benefits transactions. And like sometimes I think it's even broader than the self-dealing rules. So if you're transferring a promissory note or a business interest or something to like a foundation or a donor advised fund, then there's transactions that are going to occur between these individuals and the charitable entity. You just want to make sure that like you're either satisfying one of the exceptions, or that you're not actually going to be hit with the excise taxes. And Zach, maybe before we go on, you can take a second to like talk about the ramifications of what happens if you violate one of these rules.
So with excess business holdings, the way that the IRS discourages private foundations from having excess business holdings is through excise taxes. And essentially, there's an initial excise tax of 10% of the value of the excess holdings. And then if the foundation doesn't correct the excess holdings with a specified or within a specified period, then there's an additional 200% excise tax on the value of the excess holdings. And that excise tax is on or imposed on the tax exempt entity, whereas the self-dealing excise taxes are imposed on the disqualified person. And they have similar excise tax of 10% on the amount involved. And then if it's not corrected within the specified period, then it can be an additional 200% excise tax on the disqualified person.
Yeah, you don't want to be in that situation. So just like I don't even remember like what they are, because we try always like to avoid them. So like navigating these rules beforehand is critical. Another key concept is unrelated business income tax. And like basically, like if there's a trade or business that's not related to the charity's primary purpose, there's tax imposed on the income that's derived from that trade or business. And so like you can imagine how that becomes relevant each time we have gifts of complex assets, because charities are not in real estate or in other trades or businesses. And so like you want to make sure you take that into consideration anytime you're making a gift of such an asset. And the last concept on this page is like the bargain sale rules. In other words, like you have a sale or a transaction anytime you transfer assets to charity for less than fair market value. And then the difference between the fair market value and the amount realized is like the charitable deduction amount. And then the rest is like a traditional sale where you're triggering income. Now, this becomes very relevant when you have like partnerships or LLCs with or if they hold assets with debt. Anytime you have outstanding debt, you have these rules kick in. And so like it's a big no-no when you have these like partnerships with a lot of debt. Like you can't just give that to charity and hope nothing happens. Like there's going to be some ramifications, and you want to make sure that like you avoid all of that stuff. I think that's enough for this page. We can get into some of these concepts a little bit more when we go through the examples. I'm going to turn it over to Zach to like talk about these charitable contribution deductions. So a lot of times clients make gifts to charity because they want an income tax deduction, but like depending on the asset and the entity that's receiving the asset, you don't always get what you think you're going to get.
Yeah, so we just wanted to level set and provide an overview of the individual charitable contribution limitations. And so we set out high-level overview of the cash versus capital gain property contribution and the respective limitations, whether you donate to a public charity or DAF or donate to a private foundation. And essentially the main takeaway that we wanted to note is with capital gain property, obviously the AGI limitations are lower, whether you donate to a public charity or to a private foundation. But when you donate some of these more complex assets, a non-publicly traded asset to a private foundation, then there are certain reduction rules that actually limit the charitable deduction to your basis in the property versus fair market value. And so those reduction rules, just to note, don't apply to publicly traded entities, like if you donate Apple stock to a private foundation, then those reduction rules wouldn't apply. It's specifically like non-publicly traded assets. And then also the reduction rules don't apply to a donation to a DAF. It's specific to a private foundation.
Yeah, and that's critical. Like we've had a couple of cases where we've had to divert the gifts from going to a private foundation to a DAF because the client had almost no basis in the asset. And like and a lot of times they've held these assets for many years. They've barely put any funds into these businesses or LPs or LLCs. And so like their basis is almost zero sometimes. And if you give it to a private foundation, you're limited to cost basis. Whereas if you go to a donor advised fund, you can change the results. And so like we're not going to spend a lot of time talking about cash gifts to charity because that's pretty simple. You see these limitations on here. A lot of times we're dealing with properties and assets in the second category. And as we're going through the rest of this presentation, we're going to be talking about some charitable trusts, how they work, who's the remainder beneficiary, is it a foundation or a DAF? And like it gets confusing, right? So, and when you're dealing with big clients and big numbers, you got to get it right. So what I found to be very helpful is usually modeling these things out. And oftentimes, like you want to model out, like if you gift this asset versus that asset, and what if you have this, like it's usually a matrix. So like you have the asset, the beneficiary, and then the limitations, and then like you kind of get what's the upfront deduction, and then and if it's a charitable trust, you can forecast into the future to like see like which one will leave the most for charity and which one, and vice versa. How much can you leave for family members if you want to do like that type of planning? But before we jump into the charitable trusts, Zach, do you want to talk about the carryover rule?
Yeah, so essentially, if you have a carryover, if you're over those limitations, for individuals, you can still use that limitation or the carryover amount within the next 5 years, and outside of those 5 years, then it would be it'd be lost. So you would need to monitor any charitable contribution carryovers at the end of the year before you make any additional contributions to make sure that you are able to utilize those carryover amounts within
So
that 5-year period.
You want to incorporate that into the model. So like,
yeah, exactly.
Like what's the income? What's the projected AGI going to be? Can you use it? And in some years, your client might say, if I'm not going to be able to use it, I'm going to wait until next year to make this transfer. And so like, you just want to make sure they don't make too large of a transfer and then they can't use the deduction and then you have an unhappy client. So it's important to do like some upfront thinking and modeling just to make sure you're getting the benefit you thought you'd be getting. We can jump into the next slide. So we're going to talk about charitable lead trusts and charitable remainder trusts. They're very, very commonly used when it comes to making a gift because clients want to try to, retain something for their family through the appreciation of the assets. Sometimes they want to have more control and they want to keep the assets in trust. So for various reasons, clients like to use these trusts, and we'll give you a few examples, but it's always easier to go straight into the donor advised fund or straight into the foundation, whatever vehicle you're using. And these trusts are complicated, and clients, they sound really appealing at first, but after a few years, they're like, I don't want to deal with this anymore. Like, it's not even worth the headache. So just make sure like they understand like the administrative burden that goes on with carrying on one of these types of trusts, but they do have some very important benefits that we can talk about. A charitable lead annuity trust basically pays an amount to charitable beneficiaries in the beginning of the trust term, and then at the end of the trust term, the remainder passes on to non-charitable beneficiaries. So again, in the beginning, it goes to charitable beneficiaries, and then it goes on to non-charitable beneficiaries. It's the reverse of a CRT. A charitable remainder trust first names non-charitable beneficiaries, and then it ends up giving assets to the charity. And they're used for different purposes. What are the benefits of a CLT? So the main benefit, and again, this is in a grantor CLT. So charitable lead trusts can either be grantor trusts or non-grantor trusts. And if you have a grantor trust, you get an income tax deduction for the present value of the lead interest that's going to charity, but only if it's a grantor trust. And then if the assets appreciate greater than the discount rate, then the excess appreciation can pass to family members free of transfer taxes. Again, these trusts work best in low interest rate environments. So we don't see too many of these, but we're still hearing about them, and we see less of them now, but they're still going on. I think it's important to like think about or understand the differences between a grantor trust, charitable trust, and a non-grantor charitable lead annuity trust. In a grantor CLT, you get an income tax deduction up front because it's a grantor trust and it flows through to the grantor. In a non-grantor CLT, there is no upfront income tax deduction. So why would you ever do a non-grantor CLT over a grantor CLT when clients often want this deduction? Grantor CLT sounds really good because you get the deduction, but there's a catch. They have to pay tax on the income over time. And so like they get this huge deduction up front, but in your model, you should show them, look, you're going to be paying tax over the years. So like, is it worth it? And a lot of times it is because they want that deduction up front. I typically, I mean, I know there are a lot of smart people on this call. I typically see these grantor CLTs as an income tax play. I don't really see clients doing this to transfer assets for estate tax reasons. Prove me wrong, but it's just in my experience, typically you see this when you're trying to generate a deduction. Recently, I've been at least twice in the last month, clients are asking me about increasing payment class. So like you have this grantor trust where you're getting this big deduction up front and the charity gets a little bit every year and the payments increase over time with most of the payments coming towards the end of the term. The benefit of doing that is that the trust has more assets in it for a longer period of time and the assets grow for a longer period. So more growth inside of the trust leaves more for the remainder beneficiaries, for the kids, for example. So I know some firms don't like drafting these types of trusts with the increasing payments, but they are becoming more common, and I've seen clients ask about them more than they used to in the past. So that's the grantor trust CLT. It's an upfront deduction, but they pay the client pays tax over time. In a non-grantor trust CLT, there is no income tax deduction. But the trust itself gets a charitable deduction for income that's paid to charity every year. So the client doesn't pay tax on the income in the trust, which the client typically likes. And the trust pays tax, but the trust also gets a deduction under Section 642C. We've talked a lot about CLTs. Testamentary clats are also like a very powerful tool. So we have clients with large estates. They feel like they've given enough to their kids or to other beneficiaries, and they want to create a charitable trust when they're gone. And a lot of times they want to minimize all estate tax. So this trust can be designed to like really generate zero estate tax. And the maximum amount that needs to go to charity to reduce the estate tax to zero, that's what you could do in a testamentary clat. One thing to keep in mind with CLTs is that they could hold S Corp shares. So a lot of times we see clients, S Corps are just disasters all the time. So clients want to give them away. and like they're like, what's the best way I can give this away? You can't use a CRT. We'll talk about that in a second, but you could use a charitable lead trust. Recently, we had a case where a client wants to give away a bunch of hospitals, and they're all held in S corps. And we've had a few discussions with the foundation about this. Is like, can we do this through a CLT? And like, it's really complicated, but we're trying to work through the rules. So CRTs, in my experience, are more commonly used than CLTs. In a CRT, the current beneficiaries are family members, and the remainder beneficiaries is a charity or charities. Typically, you see this when you have low basis assets and you want to reduce estate tax, and a client wants to retain control, and they'll and the CRT is a tax exempt entity. So you can transfer low basis assets into a charitable remainder trust, and the trust can sell it with no gain. And then over time, it can make payments to the non-charitable beneficiaries. And then at the end of the term, the asset would go to the charitable beneficiary. The present value of the remainder interest, like the piece that goes to charity, must be at least 10% of the initial value of the assets. So you just want to keep that in mind. And there's software out there that you can use to like plug in some numbers, and it can give you some examples. Again, these charitable remainder trusts cannot hold S corp shares, but the charitable lead trusts can. And with the charitable remainder trust, I often see it like clients asking about it when they're about to sell something and they don't want to pay tax. And like, you just got to be worried about the assignment of income doctrine and the step transaction doctrine. So like, there's a lot of case law and research out there. We've done a lot of research on this internally on like, when is it too late? Like, you don't want to wait like till you have signed documents or like there's a binding obligation. You want to do it before then. And again, it's like a facts and circumstances analysis. And you just want to make sure that like you're covered so that if it ever gets challenged, you had at least like substantial authority or reasonable basis for like putting it into the CRT. In my experience, like if you're going to get audited on this issue and you're pretty close to the transaction, you're most likely going to lose that audit. So like, just be careful and like, don't do it when it's too late. Zach, do you want to run through maybe like one or two examples of the CRT and the CLT?
Sure. So I can start with the CRT with a CRAT. And so in this example, simple example of Jim, the donor, on October 1st, 2024, he's 65, transfers $1 million to a CRAT, reserving a lifetime annuity of $58,832. Payable annually, and the 75/20 rate for October is 4.4%. And the annuity factor for single life age 65 is 11.9. The annuity factor is derived from actuarial tables provided by the IRS, which considers the payout rate, which in this case, it would just be annually, the term of the trust, which is lifetime. If it's a lifetime annuity, then the life expectancy is considered. And then also the AFR rate. In this example, we use October, but it's essentially the midterm rate of the month the trust is created, or the 2 preceding months that you can use. With CRTs, a high interest rate environment makes CRTs more favorable because a higher AFR rate reduces the present value of the annuity stream, and that in turn increases the charitable remainder interest, which causes a higher charitable deduction. And so a summary of the benefits is the income stream to the donor receives an annuity payment for their life. They also receive a charitable deduction. In this case, would be $294,000 of their $1 million transfer to the CRAT. And then also if this was a transfer of property that had an appreciated gain, they can transfer it to the CRAT, and then the CRAT can sell it and essentially defer the income tax related to that asset to the donor. And then ultimately, it's a charitable gift to the charity organization, receives the remainder of the trust assets upon Jim's death. And so it's really best of both worlds for the donor and the charitable organization.
So that's a CRT where usually you're putting in low basis assets, there's a sale, and then non-charitable beneficiaries get this, in this example, a yearly annuity amount, and then the balance goes to charity. We can show you also an example of a CLT.
So this is an example of a CLAT. And so Amy, the donor, establishes a non-grantor CLAT. In this case, it's a 20-year term, and she funds it with $1 million. And the trust will pay out $76,000 to a public charity at the end of each year. And at the end of the term, the remainder will pass to Amy's children. And so with this annuity payment, it was structured such that the present value of the remainder interest is zero. And so one important thing to note with whether the gift was complete or incomplete is with a CLAT with a term, if the gift was incomplete and the donor dies during the term, then in this case, the full amount of the trust assets would be included in the donor's estate. So definitely want to consider the type of control that the donor has over the assets with CLTs. And then also if you're considering using a private foundation as the lead interest, there are certain private foundation rules that apply to those. And so if we go to the next slide, if the grantor's private foundation is named as a recipient of the charitable lead interest, then there are two methods the IRS allows to treat that interest or gift of the lead interest to be complete for gift tax purposes. And essentially it's revolved around the control that the grantor has over the foundation. And so the first one would be the grantor resigns as an officer or director of the foundation, and the bylaws are amended to prohibit the grantor from serving in such capacity. And then the second one is the foundation's bylaws are amended to provide that the assets contributed by the grantor are held in a separate account, and the grantor is prohibited from participating in any decisions with respect to that account. And so if either of those two methods are satisfied, then even though you have a private foundation as a lead interest, then it's still a completed gift for gift tax purposes.
Yeah, thanks, Zach. And so like with those general guidelines, you can easily determine if you should use a CLT or a CRT, and you can always run various examples if you have like a working model to see like what fits the client's desires and achieves like the economics you want. We can now jump to like the lifetime gifting of complex assets. And the first one we're gonna start with is gifting of LLC interests or partnership interests. And first I want to start with the donor considerations, because these are the most important ones. And the one that's like that I see the most commonly come up is like the bargain sale rules. If you have outstanding debt, we talked about this, or any partnership interests like that are subject to liabilities, you're going to trigger phantom capital gain. And so like that's a big no-no. So like you got to watch out. Like a lot of times like clients pretend like there's no debt, and then like you're like halfway through it and they're like, well, we have this, or like we need to refi or something. So you just want to make sure you're not going to have any issues with outstanding liabilities. You can also trigger phantom income with like hot assets. So like unrealized receivables, inventory, anything that would ordinarily trigger income tax if it was disposed. So like you can trigger tax. You're giving to charity, but you can still trigger tax, and you don't want to do that. And it would also reduce your charitable deduction amount, obviously. Passive losses, like those are like usually lost. Like it's added to the charity's basis, but if you have any passive losses, like those are going to be lost when you make a gift of such an asset to charity. And like what in one or two cases we noticed that selling the asset and using the losses like gave a better result. So like you sell it, use the losses, and then give the proceeds to charity, because different rules apply depending on what asset you're giving to charity. So anytime you have like a bunch of losses, just think about both ways of doing it. Should I just give the asset and lose the loss, or should I trigger the loss and then give the proceeds to charity? There's also substantiation requirements. So you need a qualified appraisal if the gift is over a certain amount, and you gotta use valuation discounts. If you're using them in the gift tax concept, like in the gift tax scenarios, you got to use them in the charitable scenarios too. You got to be consistent. And if the sale of a business is contemplated, you definitely should do it prior to any binding agreement. And this is a very gray area. There's a lot of case law out there on this. I've seen people do pretty risky stuff, to be honest with you. But like the further away you are from a transaction, the better it looks. And if you don't have any signed documents, like that's really important. You don't want to have any signed documents and then do the transfer. Now we'll go so these are like issues for the donor to think about. There's also issues for the charity to think about. And we touched on them a little bit. Like the first one is excess business holdings. These apply to donor advised funds and private foundations. So the charity together with the disqualified persons can't own more than 20%. Like oftentimes we try to get into that exception for passive assets. And there's an exception to the passive assets rule too, with like acquisition indebtedness, which and we're not going to get into just because we have a lot to get through today. But so that's the 20% rule for excess business holdings. Also, if the partnership is like in a trade or business that's unrelated to the tax exempt organization, you're going to have UBIT. And some clients think, you know what, it's okay. Like we'll pay UBIT. We just want to get the deduction up front. And sometimes they don't care, but it's important to like work it into your model just so they know what the ramifications are. This has become more relevant like over the last few years, like as things become more complex in everyday life. You want to make sure you review the partnership agreement, the LLC agreement. Like the charity needs to be protected. Like if the agreement requires capital calls, like the charity doesn't want to have to do that. Or like if the charity needs to pay tax, like you're going to want distribution sufficient for the owners to be able to pay the tax. And sometimes I've seen charities like, they're like, we don't want to deal with this. So like the answer was, let's get an indemnity agreement. Like we'll take this asset, you'll get your deduction, but like at least sign an indemnity. So if something goes wrong, or if there's an environmental issue or something, like we're not going to be held responsible. So that's helped sometimes with navigating these rules when you have these types of assets. So that's all about partnership interests. Now we're going to go to S Corp interests. It gets even worse. So with S Corps, all items of S Corp income trigger UBIT. That's the second bullet point on this page. With partnerships, you also have this rule but there's a look-through rule for passive type investments. But with an S corp, there is no look-through rule, and everything you give to charity, like every item of income from an S corp, including the sale of the stock, will trigger UBIT. And again, the exceptions for passive income do not apply in the S corp context. When you're dealing with S corps, you got to think public charities and charitable lead trusts. You can't use charitable remainder trusts, and you can't use a 501c4. We're not going to get into 501c4s today, obviously, because we have so much to get through, but like clients ask about them all the time, especially after Patagonia. You got to just remember, like, no S corps going into those. There is no income tax deduction, and you got to set them up during lifetime, not at death. So just a few things to keep in mind about 501c4s. And excess business holdings and the hot assets rules, like those also apply to S corp stock. And when you have like hot assets, like unrealized receivables or inventory in the entity, the charitable deduction is reduced by that amount. And sometimes it can be pretty significant. So you just want to make sure, like, it's not just the value of the S corp, but what's in there. Like, is it going to trigger a gain? Is there going to be enough distributions for the charity to pay the tax? Are there any liabilities associated with this that we need to worry about? And so, like, it can get pretty complicated depending on the asset and what's inside of the entity. So that's a little bit about partnership interest, LLC interest, and S corp stock. Zach, do you want to talk about like closely held business interest going to a private foundation?
Yeah. So a lot of the rules that we talked about are similar to gifting closely held business to a private foundation. One of the main ones is self-dealing. You have to consider whether the charitable organization will hold the business interest long term, or if there's any exit strategies, or if any of the exit strategies involve a disqualified person, because once that business interest is within the private foundation, any interaction between the private foundation and a disqualified person would be considered self-dealing. And so that's one of the main items in the next section that we'll talk about is, whether like a S corp or a LP interest that's included in a taxable estate goes to a private foundation as either a specific bequest or the private foundation is a residual beneficiary. Once it gets into the private foundation, then self-dealing between any of the other family members will prohibit those family members from buying back the interest or making any transactions with the private foundation. And then also one of the main things that you want to consider is that interest of the business will be included in the calculation of the minimum grant requirement of at least 5% of the private foundation's assets. And so, the private foundation will have to, make grants of at least 5% of their foundation's assets, while the business interest of the closely held business will be included in that. And it might put more constraints on the private foundation because of it.
I know we also talked about we talked about partnerships and S corps, and we didn't really mention C corps. Not too many C corps going to charity, but C corp transfers are more straightforward. Like, you don't have a lot of the phantom income, UBIT, and the donee liability issues that we discussed. So like you don't really have the phantom income issues either. And a lot of times we see like practitioners thinking about inserting a C corp in a structure just to block self-dealing or something. So keep that in mind. Like, it's just something that might be helpful in some cases. If you have some of these issues, consider a C corp blocker. So one thing you noticed with like planning during life with these types of assets is that it's pretty complicated. Um, you just need to have the right advisors around you, and the charity obviously can help you like navigate a lot of these rules. But oftentimes clients pass away not dealing with this during lifetime, and now everything is in the estate. So like you have an estate with stuff going to charity, and you have a bunch of issues you need to get through, and you don't have that much time. Somebody died, you have 9 months to file an extension, pay the estate tax, file the estate tax return. And during this period, and like a year or two after, we'll talk about like how much time do you really have to deal with these in an estate. There is no right answer, obviously, but you can't unduly prolong a trust administration, and you have to deal with these issues during a trust administration. So even if the client is not willing to make these gifts during life, you should at least talk about these issues that could become relevant at death. And we recently had one case where everything was going to charity, and they did some substitutions with the trust to get a step up when the client passed away. Well, guess what? Your children aren't getting anything. It's all going to charity. You don't need to be doing these transactions, or it's not worth the headache to do any of this. And so like I strongly recommend that, like, just even if the client's not doing anything, in the annual review of the client's plan, or when you're reviewing their living trust or what their goals are for the long term, just if they have charity in mind, think about these issues so you can try to navigate it ahead of time. It's going to save you a lot when the client dies, because there's already a lot going on and you don't want to have to deal with this on top of everything else. So in this one example, we had one family who made a specific bequest to a family foundation, and it was a gift of a pecuniary amount. So they gave a specific dollar amount to charity, and then the rest goes to the kids. If you can, do it the other way around, because if the charity is the residual beneficiary, you automatically qualify for a 642C deduction, because during the period of administration, you have all this income. You don't want to pay income tax. Instead, you want to give it to charity. And if you can give it to charity and avoid income tax, that helps you satisfy your charitable bequest without paying income tax. But in this one case, because clients often say, I want to give a set amount to charity. That's fine. You can give a set amount to charity. But if you do that, just make sure the trust is drafted so that you can qualify for the set-aside deduction. In this case, we had a bunch of partnership interests that held real estate. There was debt. And I mean, we dealt with one, now we're dealing with another one. And you have excess business holdings. You can't own more than 20% of the voting stock of the company. And the penalties are listed here, like they're pretty severe, the excise taxes, and you really don't want to have to deal with it. And then you also have UBIT. If it's an S corp, it's per se UBIT. If it's an LP interest, it generally includes passive type income. And you want to make sure that the charitable entity or the foundation has enough liquid assets to cover both the tax distribution requirements and any UBIT. A lot of times, like in our case, it's real estate that's subject to rent control, not much cash flow. Like this was going to be disastrous to transfer real estate with debt with no cash flow to charity. And then self-dealing becomes critical, because now you're thinking about buying assets from the estate or somehow transferring other assets to the estate. And you can't really do that. Like lending money or other transactions between a disqualified person and the charity is excluded. And you just don't want to deal with these excise taxes. So what are the options? In one case, they said, or we decided, like, we don't have any good options. Let's just keep this estate going on for as long as we can until we can satisfy this charitable bequest. And let's come up with the cash somehow. Let's sell assets. The problem in our case was the charity was given minority interest in a bunch of LLCs, and then the daughters of the client or the deceased own the remaining portion. So now if you even give the assets to the charity, the charity is going to be a partner with the family members, and like you have all these issues you got to deal with. So we decided, let's keep it open and satisfy the charitable bequest with cash or other assets instead of these LP interests or partnership interests. And we got lucky because at date of death, the value of the assets were pretty low. And over time, over the period of administration, the value of the assets appreciated significantly because the children stepped in and improved the real estate. And now they're refining the properties and they got source of cash to pay the charity. And now you don't have to deal with all of this stuff. So sometimes if you can pull it off in 2 or 3 years, in our case, it was closer to 5 years, like you can do this. Like keep the estate open. You have a legitimate reason. I know you can't do it forever, but try to generate the cash to give to charity so the charity doesn't have to deal with these issues. And in our case, it was a pecuniary bequest to charity. So anything in excess of that went to the kids. And by keeping the estate open, it allowed the growth to go to the kids. One major hurdle we had was interest. If you delay a bequest by more than a year, you got to pay interest. And the interest on a $300 million bequest to charity, like it can add up over time. So like, it's a lot, but it was the cost of doing this transaction. Fortunately, like we found a way to deduct a lot of those interest payments on the estate tax return. It's a little bit harder to deduct them on an income tax return, but I do know a couple of firms that have come up with justifications for taking the interest payments on delayed bequests, even on an income tax return. We've done it on estate tax returns. So like, there's only so much you can take on an estate tax return. Can you take the rest on an income tax return when you're paying interest because of a bequest to charity? And then at some point, you're keeping this estate open for a long time. Like at some point, like it's as if you've given the charity a promissory note because you haven't given them the asset, right? Like they're entitled to something you haven't given them, and like it's as if you gave them a promissory note. So like would a prolonged holding of these assets become a borrowing that causes self-dealing issues? So you want to make sure you can wrap it up quickly and you don't take forever to do this. The second option is the estate administration exception. And like this is a savior sometimes. It really helps. And like you can avoid a lot of the self-dealing rules if you use this exception. And using this exception requires court involvement, which sucks. And you got to satisfy a bunch of stuff to be able to satisfy this exception. But it helps because like if you don't have to deal with the self-dealing rules, that's one less thing you have to worry about. And like some of the requirements are, I've seen some cases, there's an option, a requirement or an option to purchase assets. Like the trustee needs to have the power to sell assets or is required to sell them under an option agreement. That's why you see options. You need court supervision and court involvement. And the value of what the charity gets. So let's say you're doing a transaction with the estate and you're purchasing assets from the estate in exchange for a promissory note or other assets. So now the charity gets other assets and not this tainted asset. You got to make sure the fair market value of these assets are equal. And a lot of times, like the court may have issues with that because if you're giving something that's inferior to like the court, like you may not satisfy those requirements, and what they get should be as liquid as what they should have gotten. So this, you can definitely use this exception. You just want to make sure that you satisfy the requirements. One thing to keep in mind is like the IRS is not ruling on these anymore. It doesn't mean you can't do it. It's just making people more nervous. Like they probably don't like it. That's why they're not ruling on it. But to be honest, like we still see this done. And so like, even though they have this no rule that they issued on this topic where they won't rule on it anymore, like you can still use it, and we see it used. Option 3. So we talked about option 1, we talked about option 2. Option 3 is deal with this. Like if you have no options left, you can just distribute the assets to the foundation. Like in most cases, this doesn't happen because of the bargain sale rules. If you have debt, like you're going to trigger gain. And you also could have Keenan gain from the distribution of appreciated assets in satisfaction of a pecuniary request. So if you're drafting a trust, try to avoid pecuniary requests because of these reasons, because it just makes it more difficult to administer the estate later. Let's go to the next slide. Zach, did you want to touch on this really quickly?
Yeah, so it's the same example. The decedent's estate, mostly comprised of a business interest, makes a specific bequest instead of a family foundation. It's a 501c3 org. And so a lot of the issues are minimized with this scenario, except for you still have UBIT that we've touched on a couple times, and then there's no excise tax assessment with regard to excess business holdings, and so that's one main difference between having the foundation versus a 501c3 org as the recipient. And then as far as self-dealing, if the family controls 35% more of the 501c3 org, then the entity would be a disqualified person. And so you would need to consider the self-dealing with regard to that.
And then our last example is like client did a bunch of estate planning. They gifted and sold assets to trusts. And now the client dies owning a bunch of promissory notes that are supposed to go to charity. Like these can create self-dealing issues also, because you have promissory notes in the estate. And a lot of times these are pretty large notes. Even if they go to charity, like are the kids going to have enough cash flow to make payments under these notes? So some solutions we've seen are listed on the bottom of the page. Hold the estate open as long as you can to pay off these notes so that the notes don't have to go to charity. In one case, we had third-party financing come in where you just got a loan from a bank or a third party to satisfy the charitable bequest, either pay off the notes to satisfy the charitable bequest or keep the notes in the estate and borrow money to pay to the charity. It gives you more time to deal with this. Sometimes you can give the estate administrator the option to swap assets with the foundation, so that or the charity, so that way you can pick which assets go where. Like that gives them more flexibility. Giving the notes to a public charity instead of a foundation also help with some of the rules we discussed earlier, because they're not applicable to public charities. And then what we used to see more commonly was an LLC that holds these promissory notes. If you have a structure where the foundation or the charity doesn't receive the notes directly, and they don't have control over what they get, but rather they get an LLC or a partnership that holds these assets. And if they don't hold them directly and then they don't own control, like you can argue that the self-dealing rules don't apply. But again, the IRS isn't really ruling on this anymore. But what we typically see with practitioners is if you have a bunch of promissory notes in the estate, at least dump them into an LLC, because there is no downside. Even if you don't end up using this LLC blocker, it gives you optionality where you can somehow, like if you have no other choice, you can use it to give it to give the non-voting interest to charity. So another case we're working on right now, they have a ton of promissory notes. They're giving the 1% voting interest to the client's sister, because that doesn't run afoul of the self-dealing rules. And then the non-voting interest is going to the foundation when the client passes away. So you want to make sure you set this up during lifetime, and you look at all the rulings that are out there to like make sure you're setting up the LLC in a way that matches the provisions they have in those PLRs. I know they're not authoritative, and the IRS is not issuing any new PLRs, but at least it's something for you to follow if you're thinking about using an LLC to hold these promissory notes. You can also give these notes to a donor advised fund. In my experience, it's been easier to give the notes to a donor advised fund than it is to a private foundation, for various reasons we can discuss another time. And then lastly, like, you can always use the estate administration exception. The only downside is you got to go to court. But if you do go to court and you satisfy the rules, then you at least you have the court's blessing. And you don't have self-dealing by giving those assets. Clients just typically don't like this because of privacy concerns, and court documents are available for public inspection. And then the private foundation is receiving these assets, and it's going to be disclosed on its Form 990. So it doesn't look clean. But again, if you have court approval, it's another way to get out of this issue. Lastly, if you do all of this successfully, I've seen at least in one other case where the notes ended up in the charity, and then a few years later they wanted to renegotiate the terms of the loan or make changes. Becomes really difficult to do that, or almost impossible. So just try to think about that stuff either during the client's lifetime, or if they passed away at death before these assets go into the charity, you can renegotiate or modify the terms of the promissory notes at that time. So that's I know we're out of time. We had a few more things to cover today, but that's enough for today. Like, a few takeaways that I just want everyone to have is, like, most importantly, run a model. Think about these issues and the consequences so that you know what the benefit is and what the tax consequences are going to be in the long run. On one of our first slides, we talked about the limitations on the income tax deduction. Keep in mind, a donor advised fund will often save you with capital gain property in lieu of a private foundation. So that way your deduction is not limited to cost basis. And then, like I know you got to do a model and all this planning, but most importantly, like, get the charity involved early on, because they have a lot of experience with this stuff, and they can help you navigate these rules with your lawyers, your CPAs, and any other advisors you have. So I know we're out of time, but I think we covered enough. And so if you have any questions, feel free to reach out to me or Zach, and we're happy to, like, talk to you offline. Steve, you're on mute.
You would think I figured out Zoom after all these years. Thank you, Michael and Zach. I'm so appreciative of your time and grateful to learn about these issues from you. I really appreciate you talking about how we've helped your clients. If any of you on this session or your clients would like to talk with us about complex assets or gifting strategies, please be in touch with us. We're putting up the contact information, or you should have received contact information today for the speakers, so reach out to them. And please join us for our next and last event of 2024, Tuesday, December 3rd, on the California Uniform Directed Trust Act with Michael Rosenprince and David Kunjan, both from Loeb and Loeb. I hope you'll join us. I hope that things are peaceful over the next few days, and I look forward to seeing you in December, if not before. Thank you for being here.